Cross-border payments have long been one of fintech's most stubborn problems. But stablecoin infrastructure is changing that equation. Today, I'm joined by Avinash, a payments veteran who's been in the room with key stakeholders like regulators and bank leaders, shaping digital asset frameworks, and who's now building Cybrid to put stablecoin rails underneath the products that neobanks and fintechs are shipping today. We're going to get into where the real friction lives, what's materially changed to make stablecoin adoption possible right now, and what executives need to ask before launching their first pilot. Hey, Avinash, I want to set the stage with your background. I know you've been working with stakeholders in Canada on digital asset frameworks, and you're talking to regulators, bank leaders, and policy folks. Could you tell us more about your experiences there and what vantage point teaches you about what could be some critical themes going forward?
I mean, we're an operator, and we're actually doing stablecoin payments. And so when we go through the process of getting registered with the regulators, when we talk to legislators, we're trying to give them that perspective. And what we've kind of been finding is like the GENIUS Act has sort of set a standard for what stablecoin legislation needs to look like. And legislators are largely starting to adopt that and think about how they can enable stablecoin issuers while understanding things like capital controls, risks, AML requirements, et cetera. And, when we talk to regulators in Europe around MiCA, for example, we see that those standards in the EU have unlocked issuers in the EU. There's like 200 stablecoins that are issued around the world now. And the interesting thing that's kind of started to come to bear is like people understand what the risks are, people understand what kind of capital controls are required, and now they're really starting to understand what the value props are by talking to operators like us. Right, we're able to show them that it's not just a domestic faster payment use case, it's an international and global faster payment use case that has a massive benefit to enterprises because virtually all enterprises are global as they start out right now. The interesting thing that we've been starting to see is, different legislators are starting to think about what core blockchains and frameworks they want to support. Mm-hmm. So, Japan, obviously in the US, you can run on multiple different public blockchains, like whether it's Ethereum, Solana, et cetera. Mm-hmm. And what we're starting to see now is some of those legislators are thinking about private blockchains or trying to figure out, are there risks and controls that you have to worry about on validators for a sovereignty perspective? And now they're starting to think about, like, should we have a sovereign stablecoin? And how is that different from a CBDC? Is it something that we want, domestic issuers to issue and have more control over? Or is there like a central bank issued stablecoin that we should go and promote like you see in places like China? I think the interesting thing for us is, we're trying to enable people to make a payment as quickly as possible using programmatic controls. And so for us, we're just trying to make sure that regardless of which option, people start to push down to their domestic issuers, that we can integrate to it and give those capabilities to our enterprise customers. So if you happen to be sending money to a location with a different compliance framework or a different kind of legislative framework, that we can provide that capability in a very compliant way to our customers and our partners.
Well, so that feedback from regulators sounds very positive in the sense that if we had had this conversation 3 years ago, I don't think their thinking would have been advanced about, private versus public. It sounds like they're way beyond sort of the learning stage and really thinking from a policy perspective about what's best, for their constituency. Is that accurate?
I think that's accurate. And then there's also the concerns on the speed at which some of this stuff is happening. If you're going to go and say, hey, we're going to issue this national stablecoin that's, issued maybe by a central bank, that takes a lot of time. And in the meanwhile, the world has kind of moved forward and moved on to some extent. And before you know it, you might be in a position where it doesn't provide the same kind of value as you'd hoped for. So I think what's happening is that most legislators are sort of understanding the value prop of stablecoins and trying to figure out, do we understand the risks? Do we understand things like yield as an opportunity on top of stablecoins? And that's where they're sort of focusing on, they want to make sure that, people are really understand how much capital they're holding and what consequences they might have to deal with if there's a lot of redemptions, for example. But what I would say that we generally feel is that the market is here. It's growing exponentially, and you don't want to be left behind.
So I'd love to parlay that into our next question. And you have this front row seat to how stakeholders like regulators and innovators are thinking about the space. And you have that deep payments experience through Cybrid. Can you tell us more about like the whole story? Like, who are you building this for? What's the core problem you wake up to every day wanting to fix?
Yeah, I mean, look, the core problem we want to fix is we want to enable any business or any individual to move money anywhere in the world in near real time.
Mm-hmm.
I have a brother who lives in Japan. When he had a child, I sent him Bitcoin, and it was like I sent him cash on the other side of the world, and he received it while we were on the phone. And that was, my gift to him so that he can go and, buy some things for his children.
Mm-hmm.
We're at a point now where I would say every fintech, every bank has a stablecoin strategy, and enterprises are really looking to improve their financial operations across treasury management, across payments. And the world is changing around us in the sense that every organization is looking to figure out how they can use intelligence tools and embed them into their ERPs. And so they're building this infrastructure to figure out how do we make payments move faster? And that's very difficult to do on top of traditional legacy payments, which are made of layers of intermediaries and layers of, like organizations that just pass data around because they're not so interconnected. And our goal is to make it so that you can start to use infrastructure on stablecoins with faster settlement, much greater transparency. When your correspondent has received it because you can see it on the blockchain. There's fewer intermediaries. And then I think that the part that's really interesting to us is the ability to embed those payments use cases directly into software workflows and not think about, well, my software has gone and done a bunch of stuff, so now I need my finance team to go and log into a bank and start issuing some payments. So we think about how do we provide this API layer that takes care of all the concerns that CFOs have around compliance, about risk, around making sure we have all the right certifications from an ISO and a SOC perspective. So we give them the comfort to integrate that into their organizations in a more fulsome way.
So Avinash, you mentioned in the course of our conversation so far a few different use cases, but if I'm a neobank or a digital-first fintech, what does my cross-border payments infrastructure actually look like? And maybe you can tell us about some of the friction points that customers and businesses feel due to the legacy infrastructure.
Yeah, I mean, most payment rails still run on legacy systems that were built in the 70s through to the 90s. They're optimized for batch processing. Like ACH is a file that you send to your bank, and then they process line by line batches. And, there's regional banking networks that showed up to just communicate with each other because it turned out their customers work with each other. And then there's these limited connectivity between these institutions. And as a result, you have organizations like SWIFT that were created to figure out how to connect institutions both locally and globally to pass data around. And so modern businesses are forced to operate on top of these really fragmented systems. They were never designed for real-time, global, programmable payments. There's like layers of intermediaries that are added to do this cross-border work. And then you have things like correspondent banks that show up. You have card networks, clearing houses, processors, and then you have to think about how do I take care of compliance with all these different compliance vendors. All of that adds layers of costs. And that's what neobanks and enterprises deal with today. That's how they have to try and navigate that. And then imagine trying to say, okay, I need all that resolved into an API so that I can, my ERP just tells me I'm running out of inventory. I'm ready to authorize this. I don't need to go through a whole bunch of steps afterwards. And then, at the same time, like compliance and regulatory risks and our risk requirements have increased. Like enterprises now have to go and do that work and figure out, are you sure you know who you're paying and, who you're actually paying the institution that's delivering the product and not some intermediary. So businesses also need to figure out how to manage KYC and AML and reporting and all this sort of stuff. So there's all this incredible inefficiency. It's not technology inefficiency, it's actually structural. And the interesting thing about stablecoins is it it kind of supersedes all of that. It connects two parties directly. There's still an obligation from the compliance perspective, but there's technology that allows you to do that before the payment is conducted. And so what we're trying to do is figure out how do we enable those organizations to use like this unified stack that's programmable instead of relying on all these different intermediaries and delayed settlements and all that sort of stuff. So to me, the opportunity over the next decade is just to really rebuild that whole payments infrastructure around real time programmable money running on stable coins as opposed to the legacy rails.
So let's continue down that thread. So maybe you can walk us through what that same experience looks like when stablecoin infrastructure is underneath it all, and like what changes would impact the end user, and how would product teams managing it be affected?
Yeah, I mean the big difference is like with stablecoins, the experience is completely different because the transfer happens on a single shared ledger rather than through a chain of intermediaries, right? So if you think about the steps, it's like I fund the payment, which is I acquired, like US dollar backed stable coins. I send a payment directly to the recipient's wallet. I can see on the blockchain with finality and cryptographic finality that they received it. And if they need an off ramp, we partner with a number of partners to give you those dollars in your local currency. But we're seeing enterprises more and more hold on to the stable coin, even in Mexico and places like that, because they have to turn around and pay their suppliers. The other thing that's really interesting in that is because you can get the stable coins and send it to the counterparty. We do that in about 2 minutes. You can guarantee that FX price. So today, if I went to my bank and said I'm going to send money to someone on the other side of the world, it might take days to get there. And by the time the conversion is done to the local currency, it's whatever FX they decide to give me 3 days from now, not in the 1 hour I expect this transaction to settle, or in 10 minutes I expect it to settle. So even on the payout side, there's some finality on how much money the recipient actually gets. One of the things when we talk to enterprises as we go through when we've had our discussions with them, they'll tell us like, I sent $20,000 to my supplier, and he's like, you didn't send me all the money. And we're like, no, we sent you the money. He's like, I don't know what to tell you. Like, we sent you the money. And everyone just agrees that this is just how it works. That's kind of crazy, right? And so that's the flow that we're trying to push towards. And if you can do that in a application setting, then you can do that through APIs. Since now the controls move even further into the software stack, where your ERP just says, hey, you're running out of inventory. You already know who I buy this inventory from because I've been buying it from them for a decade. So now it becomes like, okay, send a notification to my CFO to approve. I've already got the data. I'm going to hit approve. Again, log in and hit approve. And now the transaction just happens. And that feels kind of magical, but that's actually here today. And that's what we're enabling.
So one of the things that Tearsheet does for our community is kind of size up technological opportunities that are happening over the next, say, 3 years. So we're looking a little bit out and how these will impact product managers, strategy people within traditional financial institutions. We want to be far enough out where it's like it's going to be a big impact, but not too far out where like it's cutting edge and it's 10 years before this technology comes. And one of the things, so we've been covering digital, distributed ledger technology for a few years now. It feels like materially something changed over the past year, particularly with stable coins. Like the technology seemed ready, but it seemed like the industry now is adopting it in a way that it hadn't. What was that changed? Like why are we here today? And it's almost like almost every podcast we've had over the past 6 months has talked about two things, AI and stablecoins now. And so what changed?
Well, I think the friction often happens around the on and off ramps, people's understanding of, do I need to figure out how to integrate to a blockchain or not? And then there was friction around like, what is the compliance stuff that I still have to do around this? And then there's the accounting piece. Core part of our value prop is we do the accounting on the traditional fiat side and the crypto side. And so what's actually changed is you have organizations who've figured out that we have to bundle all this stuff together and make it easy for people to consume. Because the reality is like even like our fintech partners don't kind of really care about which blockchain you're using. They just want to know that you're using one that is cheap and fast and highly efficient. And so what's actually changed is is the financial stack around stablecoin payments has matured. So, organizations like us have put in compliance mixed with custody, fiat connectivity, the reporting, the appropriate accounting that meets your IFRS standards, and then layered all that into an API. So now it's easy to consume because you're not thinking about, oh, how do I do this integration to all these different things? You're like, oh man, it's simple. It's an API that I need to call, an API for my counterparty to validate that they're a real counterparty. I don't have to do all of that myself. They have a wallet. We can verify it's a real wallet and it's not some random dude's wallet. So like organizations like ours have put that infrastructure together and then made it easier for people to consume in a way that they actually want to consume it. And that has been the big unblock. And that's where, it's kind of like this, you either bundle or you unbundle solutions. And as these problems have been bundled into a core set of APIs that are easy to consume, the market has started to take off.
I have another curiosity around adoption. So I'm curious on your perspective, having been a senior product leader at large payment firms running a startup here, like you've heard all the skepticism around stablecoins, that it's just a crypto thing and that wire transfers, they were working anyway. They're easy to manage, or, people like being paid in local currency versus, having to deal with stablecoins. Like, how do you think about the questions and concerns as you're building Cybrid out?
Yeah, I mean, a big part of that was around the regulatory clarity and the legal treatment and the compliance obligations around stablecoins. You just think about how this market has matured. Like stablecoins have actually been around for a decade, and they were bundled in with the crypto market because it was a better way for you to trade in and out of Bitcoin into a stablecoin, for example. Because whether it's a DeFi infrastructure or even a centralized exchange, it's just faster to process payments in and out of a stablecoin on chain than it is to try and take it out into your bank and back into the centralized exchange. And that's kind of how it started out. And that's why there's this idea that it's kind of mixed with, crypto stuff. But I think the big unlock really has been around this regulatory clarity from the GENIUS Act. And that has allowed, banks to go and think about this. Like every fintech, every bank now has someone in their organization whose job it is to figure out what is our strategy around. And oftentimes when we talk to people like fintechs, they even call us and they're like Web2 fintechs are like, hey, my board said we needed to figure out the stablecoin stuff. Can you help us figure out the stablecoin stuff? But when we boil it down, it's like, okay, it's faster settlement. It's actually cheaper. There's better transparency. And then on top of that, there's like, you've simplified internal risk approvals because guess what? We have SOC 2 compliance. We have regulatory registrations. That's really sort of enabled people to move forward and think about it in a different way than, trading a number of different cryptocurrencies. That's not to say that people don't quite understand it or don't still, sort of paint it with a crypto is unknown and I don't understand it. It's speculative, so maybe it's not good. But you'd really have to look at the other side of the coin, which is like your regulator is saying we understand it and it's good. That's really unlocked it for enterprises.
So it sounds pretty clear from this conversation and a lot of the other podcasts we've recorded that, stable coins time is now, and that executives need to start acting. And to that end, if somebody wants to go from sort of like the we're curious stage to we have a pilot in production stage, like what are the main questions they need to answer to evaluate if their firm needs to integrate infrastructure into their cross-border stack?
Yeah, I mean, the most important thing is like, I think the conversation about is this safe to use is over. And now you need to really think about where does this create the most value for our organization? Where they're trying to get, where stablecoins gain a lot of traction is around things like, faster settlement requirements, lower transaction costs. And then there's the 24/7 availability component, right? Like I'm sending funds to the other side of the world because I buy goods from, a supplier who ships out of Hong Kong. Well, I want to know that they get it, even if it's midnight over there. And then there's that programmable automation piece. So really the common use cases that we tell organizations to think about is around cross-border supplier payments, where there's obviously some leverage, global contractor payments, there's marketplaces who are distributing to large numbers of people who are using that marketplace. And then there's like the Treasury liquidity movement, Like one of the interesting things about stablecoins is it allows treasury management to happen in a more central way. If you have, an organization like us, we have, an institute, we have a U.S. presence, a LATAM presence. You can actually manage all that from one core compliance team. And so CFOs need to start to look for a service provider who kind of offer this compliance stack with the appropriate certifications, the SOC compliance, and all the things that you would normally look for, and then say, where do I get the most value from this? You're not just doing it because it's another rail, another way to go and, do a payment. I actually believe that, organizations will optimize for the rail that makes the most sense. There's lots of, there's lots of ways to pay people domestically. You probably just use RTP or FedNav to do that if you want to do it quickly. And then if you want to pay globally, you need to think about how can I get some leverage by using things like stablecoins.
And in general, like the technologists or the product people on our podcast, when they're faced with decisions like this, they think about the build, buy, partner paradigm. What are your clients telling you about that? How do you see them sort of sizing up, making decisions along which route they're going to take in terms of developing this technology?
I think we obviously have the same kind of discussion with our own product people, right? I came from the product side, so I think about it a lot. One of the challenges for fintechs is the scale and scope of the number of integrations that you have to go and, implement and then try and layer and structure together. And so what we've really kind of done is say, what are the kinds of organizations that use stablecoins the most? And then how can we give them the full suite of tools to make it easy for them to ingest and then focus on your core business? If your core business is an e-commerce business and you're buying goods from overseas and you're selling them, then do you really want to go and figure out how to stitch together a whole bunch of different operators? Or you want to find someone who's kind of got all the things that you need and can deliver that for you so that you can continue to work on your core business? That's really where we're trying to focus on. So we're trying to, bundle in the rails and the capabilities that our customers are looking for, so you can pay in on any rail that you're comfortable with, use a card, use ACH, use RTP, whatever, pay out in all of these different countries, and have all the regulatory and compliance things taken care of. To me, that feels like a better choice than to say, I'm going to invest in doing all of these integrations and then maintaining all of these integrations over a period of time. Probably better off selecting a service provider that's already done it for someone that looks like you.
Makes sense. Avinash, thanks for joining us on the Treasury podcast today. Very interesting conversation.
Yeah, thanks for having me, Zach. I appreciate it.